While the corona numbers and the death rate is going higher in the US, also the Nasdaq is going higher and higher on record levels. How does this match? This is the IG Trading Talk. I'm Manuel Koch. And joining me now are the iconic Einstein of Wall Street, Peter Tuchman, and Salah-Eddine Bouhmidi, head of markets at IG. Guys, good to see you. How are you?
Wonderful, thank you. Nice to see you, Manuel and Salah.
Peter, just like I said, the Nasdaq is on a record level and the numbers are getting worse. How does this match?
So, you know what, I think you guys, we've been talking all along that the markets themselves are trading up on stimulus and liquidity being pumped in by the Fed, and that the market does not accept on a short-term basis, on an occasional day, net really be responding to the fact of the economic global slowdown, all the challenges we have due to the pandemic, and surely not right now, which is kind of baffling to me, the incredible surge in 35 plus states in the US of the virus on a daily basis, and that the news that's just recently come out that in fact the death rate has risen also. So we are, we've talked about it, and we all wonder, why is the market trading up 60% off the March 23rd lows, while in the eyes of an incredibly challenging and health crisis and economic crisis. It's important to note the market's doing what it wants to do. It's up on stimulus, not on fundamentals. And unfortunately, the ever evolving story about reopenings and attempts at that, spiking numbers and deaths, just while it's important for our audience to know that it devastates all of us on a daily basis, and our heart and prayers go out to everyone. Unfortunately, well, not unfortunately, it's not having an effect on the market, surely not NASDAQ, okay? So in the eyes of all of these numbers that you're talking about that are spiking, we have the NASDAQ kicking record highs. The question is why? So is this a flight to safety? Is this, and we're talking about all the FANG stocks, the Facebook, the Amazon, the Netflix, the Googles, and so on. And these stocks are trading at record highs in the eyes of an economic slowdown. Are they less pandemic? Are they pandemic friendly, to use a strange term? Are they more insulated from all the economic problems at the moment? I believe that is the case, right? If you look at the hospitality industry, cruise lines, you look at the Disneys of the world, you look, the sports arenas, you look at retail, you look at so many companies, the airlines, you look at so many companies that are really hanging their hat on a comfortable, smooth reopening, on a treatment of the virus, and the economy becoming robust and wonderful again. These stocks are not really tied to that. And I think that's why they are where they are.
We have seen also last week a great support from macroeconomic data that supported the markets. But if we just put these 5 big stocks out of our world, we don't have them anymore. Just assume that, Peter. Then this euphoria that we see in macroeconomic data didn't show any great increase in those ex-FANG stocks. So only this tech stocks just pushed with this good euphoric macroeconomic data the market. So I am always a bit afraid if I take this world B without the FANG stocks, then we are completely different. And I'm really keen to see what will happen with the market with this earnings season that is coming this week. And now is my question, Peter, to you, to make the story short. This fragile recovery that we could see will have also problems in the earnings season because people can wake up right now.
Okay, I agree with you. So you know how we know that the market is a delayed predictor. So many of the market parts are delayed predictors of the economy, and the same way. We've talked about it for a number of months now. Is the market going to catch up with the strong? Is the economy going to catch up with the strong, robust market, or is the market finally going to wake up and unfortunately start following the trend of the economy. Which one is it? Or is it going to continue to trade at a divergence? I agree with you, from what, I'm not an economist, a financial advisor, or a stock picker, but I'm here to break down the forensic movement of the market, why it's doing what it's doing. And I try to get reconnaissance about everyone's opinions, because there are plenty of them, about what earnings season is going to look like, the fact that never before in history have we have companies be as transparent as to say, started with JP Morgan at the beginning of the pandemic, I can't give guidance. There are more unknowns than there are knowns here. And so one of the three words that came out for me about projections about what may happen this week at the unfolding of the earnings season is confusing, sloppy, and shocking, right? Mm-hmm. So if you take the FANG stocks out, which are the fuel on the fire, along with the liquidity being pumped in by the stimulus package, $3 trillion, $2 trillion left to come in a much shorter period of time than we even saw in the financial crisis. You see, as Scaramucci called it, a green tsunami. That's what's keeping the market up. But if you look at the fundamentals, I agree with you. They are fragile. They are brittle, and we've seen it when the market is trading in a wild zone here. It's up on its own, and I don't think a lot of the bricks that are in this building are all there. A lot of people have been sort of pushed to the side, because when you have a market that can go up and down thousands of points on one bit of news, you know that the market's fragile, right? And I've spoken about it before with you guys, that we see that the market can be up on one little bit of good news, and then it may, in the middle of a day, news may come out that one of the drug companies that did a trial was negative, and the market will retrace 500, 600, 700 points, just like that. To me, that's a fragile, brittle market.
Peter,
going
this
back to
week
earnings season.
Earnings season is a good part, a good point. The banks will be the first publishing their numbers. So when the FANG stocks are the fuel, what are the bank stocks?
Okay, so I think it's important to note that this is a health crisis, an economic crisis, and not a bank crisis. We need to look at, this will be the first time within the pandemic that we're going to see perhaps some guidance, but surely earnings coming out of the banks. And we need to, when you start looking where we're going, you have to look where we came from. On February 12th, when the markets pre-pandemic, when the markets hit their record highs on February 12th, the economy was strong and robust and healthy. The banks had never been as healthy and robust on their balance sheet since the financial crisis of 2007, right? So unemployment was low, the economy was strong, the state of the consumer was in good shape, and the banks were healthy and robust. That is where we were as a U.S. economy on February 12th. And then the pandemic came along, and we saw over the next 6 weeks, it completely eviscerate the markets, fast and furious, down 11,800 points. Okay, so where did the banks go then? The banks were the first ones to come out and say, we don't know how this is going to affect us. I still think there are lots of unknowns. There are choppy waters ahead. We're going to have mall bankruptcies, people defaulting. We've had a massive stimulus package presented on March 23rd for small consumers, large consumers, small companies, large companies, trillions of dollars being pumped into liquidity of the market, and $1,200 sent to each American, right, who makes under $90,000 a year. Unemployment being boosted, unemployment payments being boosted by $600 a week. So there has been an attempt to make the small, whether it's the small investor or the small consumer, a little more liquid. However, these things are not going to go on forever. Okay, I think the numbers that we're seeing is people are not going to be able to pay their credit card bills. People are not going to be able to partially pay their rents. Large companies are not going to be able to still support the big malls and the big, and the rents that are going on around the country. So I think we've got a lot of unknowns around that. The banks are probably postured a little better than a lot of companies, right? Than the airlines and some of the energy names and whatnot that are and retail that are being affected on a daily basis by the pandemic. They are also the recipient, a lot of the stimulus, right? per se the banks are getting stimulus, and they are where people put their money when they need to save, right? Which is adds to their robust health. Okay, so I think the waters are going to be choppy. I don't know. My best answer to this question is I don't know. Next week we may see that they've done okay and that they have a little guidance for the future, or we may see no guidance at all and choppy waters ahead, as they announce credit card payment defaults and all that stuff. So the answer is I don't know.
So I totally agree with you that luckily we are not in a financial crisis. We are more in an economical health crisis, so that banks are completely different as in the financial crisis, of course. And so there could be actually potential of growth, because if you look on the S&P 500 and compared to the Nasdaq Bank Index, there is a divergence. There's a great divergence since the beginning of the year, where the bank stocks are falling, whereas the S&P 500 is only increasing. So could that be? It doesn't matter whether the earnings season will affect banks positively or negatively. Do you think there could be potential for the future for banks coming out of this, ground?
Okay, so as I said, February 12th was only a few months ago, right? I think, and we've lost all of our perspective, right? Suddenly, in 4 months, the world has ground to a halt economically and whatnot, and hundreds of thousands, 500,000 people around the world are dead. It wasn't years ago that this happened, and it's not over yet. We're still in the middle of it. So I think there's so many unknowns on that front, but I think the banks could be this help to the solution and not a part of the problem. As I said, this isn't a financial crisis. This is an economic one. But we do have robust markets. For whatever reason, they're going up. And the banks are a recipient of that. Okay, there are people making money in this market. The market is trading much higher. And I think whether it's support from the federal government or whatnot, I think the banks know that it's important for the recovery of the economy for them to lead the way. And they are going to have to dip into that place they were of healthy and robust balance sheet of February, right? And realize that they may have to do some cutbacks and they may do some cut spending, but they could be the solution to the problem. They could be the forerunner. They could be the leader in our recovery. As banks have often been the leaders of recessions, they can be the leaders of recovery. And and I believe they feel that responsibility. The Jamie Dimons of the world, I read a thing this morning at Wells Fargo, suddenly people are starting to notice them, a stock that had been sort of out of favor for a while. But we need to put a lot of hope and support in the banks and in the consumer, right? The banks and the consumer have a lot to do with each other in order for them to lead the way towards a recovery.
Talking about politics maybe for a second, I read that the Democratic presidential candidate Joe Biden said that he would raise corporate taxes after he would get elected. Is this a problem for Wall Street?
I'm a firm believer that politics have little to do with markets. And that comes from my research about historic data. Okay, markets, I think we're on unusual times. President Trump has been ran first campaign and now running second campaign on the strength of the market, that he's the friend of Wall Street, right? And the Democrats, whether it's the Hillary Clintons or the Bidens, have been painted as the enemy of Wall Street. And you know what? I don't like to get political, and I don't like that whole narrative. So perhaps some of the strength of I believe that the market has gone up over the last 3.5 years as a function of what went on for the 8 years before. Markets don't always respond. There's a delayed action, as how markets respond to things economically, politically, or whatnot. So I know a lot of Trump supporters believe that he's made their lives better. They are better off than they were under Obama, and that the strength of the economy, the low unemployment, and the robust banking industry and corporate America is a function, it being robust and healthy is a function of Mr. Trump being in office and all of his pro-Wall Street policies and agenda. I kind of think it's just a continuation of a strong bottom left to upper right movement that the S&P's had since the crisis of 07-08. Okay, but who am I? I'm just another poor Einstein on the bus. At the end of the day, people believe that the market was very robust and strong when President Trump came in and cut corporate taxes, tax reform, and a lot of his banking policies, regulations, and whatnot. And we saw it recently also that with the retraction of the Volcker rule, right, that you have hedge funds that are allowed to do things that they couldn't do before. I don't think that, perhaps Joe Biden, if he becomes president, will roll some of these things back. I kind of think that it's just a few months away. And I don't think that anybody will advise him to, wherever we are come November, we're still going to be in the midst of a pandemic. We are going to be at the beginning stages of a recovery at best. And I don't think anybody in their right mind would be advising him to do anything that may have negative impact on the market and the economy so quickly, still within the realm of the pandemic. You know what I'm saying? So perhaps he may roll some things back. There may be a short-term knee-jerk reaction to it. But net, the market, I think, goes up on other things, fundamentals, and right now stimulus, irrespective of who's the president.
And back to earnings season. A lot of traders, and I am also a trader and an analyst, but often people come back to me in earnings season, and even especially new traders, they ask how to react, how to behave in earnings season. And it's an honor to have you here, so much experience here right now in this interview. How should people behave, especially if they are rookies in this time of earnings season?
I think that there's no playbook for this earnings season. I think that the earth has been scorched. There are new rules going on. Normally in earnings season, people research all the different opinions. They have transparency into the balance sheet and guidance of these companies. And they're willing to they're able, with all that information, to make a decision. We know markets, there are people who buy, and at the same time, somebody for the right reasons, and then there's someone selling it to them who thinks it's going the other way. So the markets basically trade on information. Right now, where I think we are in a new rule mode with no playbook, is we are in a major lack of information and a story that's evolving on a day-to-day basis, causing massive spikes and sell-offs in the stock market. So my suggestion, while the earnings play is a fascinating play, we've got that old premise on Wall Street: buy the rumor, sell the news, right? If you look historically at how stocks react to earnings, the reaction has so much to do with the expectations. Everybody puts out their numbers on what they think they should be, okay? And then they have the expectations. Often what we've seen over late is that expectations get lowered as we get closer to the release, to the point where no matter what, it's either going to be an overreaction on the upside or an overreaction on the downside. So for a novice trader, I would suggest to stay away from this trade, because not only has that been going on, but we have no guidance for what's going on. This story is evolving on a day-to-day basis. I think the safest thing that you do for a recommendation to anybody trading right now is to step away from the earnings trade and trade on technical analysis, okay? The chatter, the headlines, the social media tweets, okay? What's happening on a day-to-day basis in the world, evolving around the pandemic, whether it's the health issues, the retail issues, the consumer issues, or whatnot, are huge. Hope is not a strategy. I can't buy a stock hoping it goes up, because anything can happen on a daily, and we've seen that happen. So my gut is, in technical analysis, okay, stocks, it doesn't matter what the stock is. It doesn't matter what the headline or the tweets are. It trades on triggers and targets from historic data about how stocks react, whatever the company is, okay, when things move away from their moving average, when things double bottom or double top, all the different things that fall into the 5 categories and strategies of technical analysis, that's where people should base and learn how to navigate this market, because it's a wild and crazy ride. It is ruthless. It's not a place for the weak of heart, right? And that's the best recommendation I could get.
Totally agree. Especially you brought something into my mind. Technical analysis is also valuable if markets are not so efficient, or if the information, if we have a lack of information, then it's technically and scientifically proven with performance that you could better be with technical analysis than just looking on fundamentals.
Correct. Technical analysis offers you the probability, if done correctly, to win more times than you lose. That's historic data. I'll say one last thing and I'll end it here. That I saw a graph that overlaps the market in 1929 and 2020, right? 100-year market from 1920 to 2020, and it's overlapping itself to a T. Unfortunately, what happened after 29 was after 20 So the 100-year market from 1920 to 2020, the markets overlapped, right? Are identical, except that from here, the market went lower and culminating in the crash of 1929. I'm not giving anyone a predictor, but it's historic data is in absence of a information highway that we don't have at the moment. Technical analysis is the key.
Peter Tuchman, the iconic Einstein of Wall Street, and Salah-Eddine Bouhmidi, head of markets at IG. Guys, thank you so much.
Auf Wiedersehen. Nice to see you all.
And
thank you.
I see your
Danke.
German is great. Guys, thank you, and thank you for watching. For more information, go also on the website ig.com. Thanks for this week. I'm Manuel Koch. See you next week.